Welcome to IGO, episode 4. That's In Good Order, the podcast for financial practitioners looking to scale with clarity and confidence. I'm Ben Braverman, senior consultant at SMS Financial Solutions, and now it's time to get in good order. Today's guest is Drew Carpenter, my colleague and friend from the home office in Omaha, Nebraska. Drew, how you doing today?
Doing well. How are you, Ben?
Doing very well. Today, for listeners, we're going to be talking about what I consider one of the most underutilized, but perhaps most valuable at times tool in the toolkit of insurance strategies that can be applied to retirement planning, retirement income planning, portfolio insurance. There's going to be a lot of ways to categorize it. And that would be variations in any form, quite frankly, of long-term care. Long-term care is incredibly important to me. 3 years ago, my father developed early onset dementia. He had a pretty rock-solid retirement plan. He had a pension, good health care as he was a college professor, and even an annuity in his portfolio. He also had a long-term care policy. Upon developing early onset dementia, his rent went up fourfold. This would have been devastating to his legacy, devastating to his savings, devastating to his retirement income plan, but luckily he had a long-term care policy in place. I know I'm not the only person that has a story like that. More and more people from the sandwich generation up and down do, making this topic that much more important. So Drew, let's dig in. Why is long-term planning more relevant than ever? Let's talk about, and I know you're the expert here, aging demographics, the costs, the legislative changes, the statistics.
And I appreciate you sharing that personal anecdote. We'll talk about that a little bit later as a useful strategy and broaching the topic with clients. It's a great question. Why is it more relevant than ever? I don't know that it even is. I think it's been relevant. It's been important. And we'll talk about some statistics and some of the factors driving it. But I think everyone tuning into this podcast is well aware of kind of the demographic shift in this country over the last 13 years, and the silver tsunami, the amount of baby boomers, folks turning 65 every day. That is putting a real strain on the healthcare system. Costs have gone up faster than inflation, cost for care, regardless of what part of the country you live in. We're facing caregiver shortages. We can go on and on, but I think fundamentally there's been a gap between client expectations and client needs and what we've done as an industry, to initiate this conversation. So is it more important than ever? Certainly, but I think it's always been important, and some of the same factors are at play. But luckily, we have a lot of good options at our disposal to help solve this problem.
I assure my listeners today, many of whom are my existing producers or potentially future producers, this is not a product pitch. But that being said, and this is a wholesaler statistic, less than 25% of retirees have any form of long-term care. And feel free to correct me on what that exact statistic.
Yeah, it's certainly less. And it's kind of a moving target, but you pointed out whether it's 25%, 20%, whether it's 10%, we are severely underinsured. And that is probably a fault of the industry, right? Of folks that sit in our chairs. And, we need to be more proactive in initiating the conversation.
So then, in your opinion, the producers listening to this podcast today, doing millions of dollars in annuities and AUM, maybe doing a little bit more index universal life when appropriate relative to the episode, or they're starting to think about it relative to the episode last week. What's with the dearth of long-term care production, assuming I'm using that word of the day correctly?
I like that word of the day. Yeah. Significant lack, right? Dearth. So, I think it is a combination of a misconception about the products that are available. And like I said, we're not going to talk about product per se and, dig into any particular product. We're not promoting that. But we do want to talk about how the solutions have evolved, right? Because that does inform the type of conversations we have. When we think about the evolution of the industry, starting from traditional long-term care insurance to what it looks like now, there are some really significant misconceptions on the advisory side about what the products look like, what the solutions look like. And then, because folks didn't feel like there were adequate or appropriate solutions to present, then we all just kind of collectively ignored the conversation, right? And didn't broach it. There are some folks who have been really aggressive in identifying how, we want to have some micro strategies within the plan to support a self-funding approach. Ultimately, the majority of people, if you don't have insurance, you are de facto self-funding. And so, I think a lot of it's the misconceptions. And then there's also a misconception that our clients are not prepared to talk about this, right? Which I really want to hit on this up front. Lincoln Financial, one of our partners on the product side, released the results of a survey in 2023. And I think it was a fairly statistically significant survey. It was over 1,000 adults that were interviewed, folks that work with financial professionals, and of those people, right, 95% of them reported that they feel like a financial professional should be talking to them about long-term care. I mean, I don't know that we have 95% agreement on anything in this country, and yet only 35% of those folks reported that a financial professional had discussed long-term care planning with them. There's a huge disconnect.
95% of those consumers said they'd like to have a conversation or they wanted to have a conversation about long-term care. Only 35% had those conversations.
Staggering, right?
You used
Now,
to be a long-term care wholesaler specifically in your prior career. We didn't do an introduction, and that's on me as I figure out the landscape of podcasting, proper structuring, including, by the way, for my YouTube viewers, I was not aware that I grabbed my wife's Real Housewives mugshot mug this morning, so I acknowledge that. And if you're a Bravo fan, I'm gotten to the channel, but it
I
just
like it. Now it's just an ongoing prop.
it's an ongoing prop. Maybe it'll become a mechanism in the future. But I'm sorry, I digress. So when you were wholesaling, or even now in your role where you cover both annuities and long-term care, that 35%, you've had those conversations with RIAs and registered reps, as opposed to the client objection. What's the producer objection?
Yeah, so it kind of dovetails on it, and let's hit back on that survey that Lincoln published. 66% of, they interviewed also 1,000 consumers, 1,000 financial professionals, right? And 66% of those professionals reported that they feel like long-term care conversations are not a priority, or that they're too difficult or depressing to discuss. At 98% of those surveyed said that their clients have needed some amount of long-term care. So again, huge majority saying we know that this is a risk. And a huge majority of clients saying we know we want to talk about it, and yet that when it comes to actually having the conversation, there's a disconnect. I think it's a feeling of not being competent in the space, right? Not knowing all of the solutions at your disposal, not knowing how they've changed, just hearing kind of negative feedback. If you think about coming into the industry and you join a firm, or you have a mentor and they talk about the traditional style of policies and how they've been burned by them, right? That just leaves kind of a lasting impact in your approach. And it's going to be different for everyone, but that feedback that, hey, my clients don't want to talk about it. That was the number one objection I would get. Not that long-term care planning isn't important, right? It was that, hey, my clients don't want to talk about it, but yet we're seeing that they do, right? And so I think that it's incumbent upon the professional to establish a standard, right? That we believe this is important, and we're going to incorporate this as a regular, ongoing part of our practice. And that's the way to most successfully do it. Not everybody is going to get covered. Not everybody's going to be interested, but you're going to address more of the risk, and you're going to be able to look yourself in the mirror and say, I did the right thing for my clients. But from a regulatory standpoint, there's some protection here built into just having the conversation and offering a solution.
Let's dispel some of the myths. Medicare covers it.
Nope. So I mean, and that is a big misconception. I think it's important to remember too that we deal with products, we deal with the facts of the landscape every day. Consumers don't, right? I mean, they don't understand the nuances of their existing healthcare coverage. They don't necessarily understand the nuances of Medicare, particularly before they start to enroll, right? And when you enroll at 65, and that's oftentimes later in the game for long-term care planning, kind of counterintuitively. Medicare does have some provisions for long-term care coverage. They're very limited though, right? So if you're in a facility for 3 consecutive nights, in a hospital, right, truly in a hospital facility, and then you're discharged directly into a rehab or skilled care facility, Medicare will pick up a portion of the bill for up to 100 days. And that's it. Right now, Medicaid does provide long-term care coverage, but Medicaid is for folks with very limited assets, right? Very limited resources. We have strict asset and income restrictions. It varies by state, but it is designed for folks that don't have the means to pay for care themselves. And so, that misconception leads to one of my core facts. And we can talk about statistics all day. You notice I haven't really gone into them yet. I think there's a place for them, and we'll talk about some of them. But I like to boil it down to some of the most coherent takeaway facts, right? And one of them is the fact that Medicare does not pay for it, the fact that private health insurance does not pay for it. Without a significant spend down strategy or transfer of assets, your clients will be on the hook for these expenses themselves, right? They will have to self fund.
That's misconception number two. I will self-fund. The whole point, I know the answer, but you articulate it better than me. And part of the purpose of this podcast is to bring the conversations going on internally at SMS as well as externally with our vendor partners, other producers, other thought leaders in the industry, and bring those to producers. So one of the conversations we've had is self-funding. That's not self-insuring. That's not even a concept that should be recognized. We should eliminate that word from the
Mm-hmm.
financial planning dictionary, because insurance by its very definition, be it an annuity, be it life insurance, be it long-term care, is some form of leverage. It's a unilateral contract of adhesion between you and the insurance company, whereby in the event that there's a trigger of some sort, you are going to get back a larger benefit than what you paid in. So I sort of laid the table out there for you. Tell me why, if I say I'll self-fund, I'm a multi-millionaire, or even if I'm a mass affluent individual with $500,000 to $3 million in assets, whatever side of the spectrum you may be on as a consumer, tell me why that's so wrong.
Yeah, so multifold answer, right? Just because you can do something financially doesn't mean that you ought to, right? First of all, I mean, at what point do we stop trying to generate returns on our savings, right? At what point do we stop making otherwise smart financial decisions, particularly if we're working with an advisor or planner, right? I mean, never. We continue to make optimal decisions, considering all of the factors, right, including opportunity costs and predisposition, all those things. But just because you can doesn't mean you ought to. What are the true impacts of self-funding? It's really easy to look at a balance sheet and say, well, here's how much I have in assets, and here's how much care is going to cost, and X is greater than Y, so I'm good. And, whether even that's a wise approach or not, let's pick that apart. I mean, you don't pay for something with assets; you pay for something with income. We have to turn that asset into income, and so let's drill down on where is that money currently sitting, right? Is it in a qualified account? Is it in non-qualified accounts? Are we going to be subject to taxation? Are we going to, what if we are self-funding in a really nasty bear market, right? I think most of the folks on this call understand the concept of sequence of returns. That is worsened by a long-term care event. Can't time the markets. We cannot time our health either. Additionally, we'll get the conversation with advisors. Say, well, my client has a couple of pieces of property that they're going to sell and liquidate. That would be the first set of money beyond their financial plan. Okay. What if you're in a, strange, lingering, high inflation, high interest rate, maybe stagnant growth scenario, right? And now you're forced to sell a property in less than ideal real estate market. I mean, the list goes on, and we can illustrate it, but folks that are using planning software can model this, right? We can run a Monte Carlo, we can run scenarios in, bear markets, bull markets, and show what the impact is. But I mean, the real fact is here, every dollar that you spend on care is a dollar you don't get to spend for something else, right? So why do you end up saving more money than you quote unquote need for retirement? And there's different beliefs on that, but the majority of your clients are going to have some money for some legacy purpose, right? Whether that's kids, grandkids, causes they care about, whatever it may be. And every dollar you spend on care is a dollar you don't get to give to those causes, right? And then as we move down the scale to the less affluent kind of mass market folks, there's a real scenario where we run out of money, right? Or our quality of life has really, really changed. The retirement we envisioned is different. We're no longer traveling. We're no longer having those experiences that we put off, oftentimes so we could save this money, right? And so a lot of folks can self-fund. I will tell you, over my nearly decade talking about long-term care with advisors and producers, the best clients we've had have been high net worth ones, right? I mean, the folks that could self-fund without a problem, even some of the folks that could, buy a wing in a nursing home without a problem, they look at the numbers and say, well, I mean, I inherently understand the value of leverage. I've been using leverage most of my life. Well, why stop now, right? Let's transfer some of the risks to the insurance company and free up some of this legacy for something else we care about.
What is the statistical likelihood? I've heard 70%, but that a 65-year-old will have some type of health impairment event.
Yeah, that is kind of the gold standard kind of need measurement, right? So if you live to be 65 in this country, you have a 70% chance of needing some amount of care in your life. Now, how much care? How much is it going to cost? Where is it going to occur? I don't know. Right? There's a lot of nuance to that, but point being, the longer you live, the more likely you are to live longer, right? Life expectancy for a 60-year-old is like in your mid 80s. Needing some assistance with 2 of the 6 activities of daily living. And important to note here, that doesn't have to be a nursing home. And in fact, most people don't want it to be, and most carriers would prefer you stay in the home because it's less expensive, right? So the need is very real, and the cost is very real, right? I mean, this is maybe segueing into what you were going to ask next, but it doesn't matter where you live in this country, doesn't matter where the care occurs, it is expensive, right? I mean, anywhere between $5,000 to $15,000 a month today for average care. Very few people want to go to an average facility, right? Especially folks that have been fortunate to earn and save money. That cost has gone up faster than inflation, even in years where CPI has spiked, like recently, right? So it continues to grow. It is incredibly expensive. And we could talk, for any of the folks that are interested in how to drill down on this. I mean, planning software oftentimes will pull data in. That data is as good as any. I like to use the Genworth website because they've been doing the survey for a long time, and they originally had a lot of data on claims, and they've expanded it out to actually calling facilities and providers in various areas. So you could drill down on a zip code and see, hey, here's what the care is, here's what it's projected to be over time.
Listeners, we will put a link to that calculator both in the YouTube comments and in the subheading on Spotify and Apple Podcasts.
And thank you for that, Ben. So I will say that when we talk about the cost, right, it's expensive. These are the 3 facts that I want everyone to take away before we talk about solutions and kind of how to position things. Again, we could talk about statistics all day long. The 3 most important facts about long-term care, in my opinion, right? It is expensive. Somewhere between very expensive to wildly expensive, but it is expensive. Your clients are likely to need it. 70% chance that somebody who lives to be 65 will need care at some point in their life. Fact number 3, without transferring the risk to an insurance company or without a significant spend down or transfer of assets, your clients are going to be responsible for the cost themselves. Right? Those 3 facts, should serve to justify why we should engage with a proactive, solution-oriented conversation.
How to start the conversation without creating fear. One of the reasons I shared that somewhat personal experience that I've had with my father with long-term care is one of the most compelling long-term care presentations I saw was from a wholesaler who shared a similar experience. He said, I sell this strategy. My parents have this strategy. If my parents didn't have this strategy, my wife and I would have a roommate. And while there's an extra third bedroom in this house, I don't know if late 30 dinks are necessarily looking for an 83-year-old roommate in my particular case. What other conversational starters, or do you think that those types of probing questions, given the high probability that somebody in a client's life, in a producer's life, in a practitioner's life, has had this shared experience?
Yeah. So, I mean, just starting with the question, right? Hey, do you have any experience with long-term care? Because just statistically, right, the amount of people that have needed care over time in this country, the age of your clients, the demographic of your clients, there's a pretty high likelihood that your clients have had some exposure, right? When I do a client seminar and we say, hey, who in this room, raise your hands. Let's see who in this room has had an experience with long-term care, friend, family, direct family, extended family. You get, I mean, 70% of the room, right? So I think, starting with the question and letting your client tell you how they feel about it is step one, right? And then you're going to gauge from there, just like you are with anything else you discuss with your client, right? What is their disposition towards it? You're going to have folks that say, gosh, I'm really glad that you mentioned this because we're currently dealing with this with, my mother-in-law. Or, I watched my grandma, she had Alzheimer's. I mean, the stories go on and on and on. And I would venture to guess that of the folks listening to this podcast today, we probably have similar representation, right? So what is the disposition of the client? Now, if you have a client that tells you, I don't want to talk about this, period. Okay. I mean, we can't force folks to engage, right? You can lead a horse to water. I would recommend for folks to have some type of documentation process in place so they can show, a regulator or a future inheritor, hey, we had this conversation and this person said no, and I don't want to talk about it. But in my experience,
You're
that answer is
talking
often not no.
children of clients in terms of multi-generational asset retention. And I've heard about this as many RIAs and registered reps that do try to advocate for long-term care and or use a long-term care point of sale service if they're strictly fee-based or however their practice is structured, saying, if you're not going to get this from a fiduciary perspective, I need you to sign this acknowledging that you're not going to get the long-term care. That's both a protection for the practice as well as when the beneficiaries come for the perceived legacy, and that legacy has been eviscerated because of those healthcare costs.
Absolutely. And, some of the most successful practices I've worked with over the years that have incorporated this as a regular, consistent part of the practice do exactly that, right? And I will say, let's think about that component on a positive note, right? So we know that there's the fact of life here from an advisory standpoint is the inheritors of wealth, by and large, do not stay with the advisor that their parent or spouse had. Not and you talk to people and say, well, my practice is different. I hope so, right? But how do we? I mean, that's just an inherent risk of attrition. How do we address that? Well, there's a lot of different ways, but if you're able to successfully implement a long-term care plan, the follow-up to that is, hey, can we set up a meeting or a conversation with your kids or any other stakeholders, so to speak, in your plan, just so we're all on the same page about what your coverage looks like, what kind of care you're looking for down the road. And that right there that's a bridge, an intergenerational bridge to the next clients. And not only that, but we're also, by definition of the insurance we're providing, preserving some of that legacy, which becomes a future asset for management, right, with a new client.
Some practice protection, something you and I spoke about a few weeks ago, is it's insurance on your book, be that assets under management, or if you have a large book of annuities with the intention of eventually selling that book of annuities.
Yeah, certainly. I mean, look, if you have to self-fund, the first set of assets we're going to go after, typically assets that may not be under management, right? I've got a CD at the local credit union or bank. I've got some cash buried under the mattress, whatever it is. We're going to burn through that, liquid cash or cash equivalent pretty quick. And then where are we going? Right, we're going into AUM. And so, if all of your clients are self-funding, maybe your intention is just to work your practice until you're done and then hang it up. Most folks have some type of succession goal or wish. If we've cannibalized our AUM by ignoring long-term care planning, what does that succession opportunity even look like? Let alone your, opportunity to be acquired.
So if you're working in the retirement space and you're not either positioning long-term care, hybrid long-term care, which we'll get into next, or using a long-term care point of sale opportunity, what I'm talking about there is here at SMS, we have the ability to bring in a long-term care insurance professional who will facilitate the entire strategy for you in truly a turnkey method. But if you're not doing that, then you're essentially assuming you work in the senior market, nearly 70% of your assets under management at risk to some degree, relative to the cash and whatnot on the sidelines.
I think that's well said.
Let's dive into product a little bit. Hybrid long-term care or traditional long-term care, not is one better than the other, but where is the trend going relative to affordability, portability, and overall effectivity? Because the golden plans, it's my understanding, are few and far between now. What I'm talking about is like lifetime benefits or things along those.
Yeah. So I think, just thinking about the evolution of the industry kind of puts it all into perspective, right? So your first iteration of these products, all the traditional variety. And when we say that, we mean the pay-as-you-go model where and there's been some evolution and nuance to this, but just think of it as a premium that you pay indefinitely in exchange for a bucket of long-term care money, right? No other account values, no death benefit, no cash value. And those products were built on what we call a guaranteed renewable contract chassis. So that sounds good, guaranteed, cool. Well, yeah, that means they're not able to kick you off of your coverage. However, every year when that policy reviews upon its anniversary, the insurer, the issuer of the contract, has the ability to adjust the terms of the contract so long as they do it for an entire underwriting class, which
By
means
terms, you mean the rates, the amount that the
correct.
consumer is going to pay in.
Yeah, so either the premium amount or the benefit that premium buys you, right? Now, I guess theoretically that means they could lower the premiums, although I've never seen that happen. I mean, the fact is they are able to raise the rates and they likely will raise the rates. Now, the original iteration of these policies, if you bought one of those and went on claim before rates skyrocketed, that's the best money you ever spent, right? Because they were too cheap, turns out, in retrospect, right? So the insurers, the carriers, started to realize how severely they had underestimated the risk, both from a cost standpoint as well as a persistency standpoint. They thought a lot more people were going to let these policies lapse, and they didn't because they were a great value. And so the ability to raise rates turned into the fact of raising rates. And that, became really untenable for a lot of folks, right? The use it or lose it proposition is okay if it's an affordable premium, right? I mean, setting aside the fact that homeowners insurance is legally required for people with a mortgage, if your house doesn't burn down, you don't say that you wasted your homeowners insurance premiums, right? I mean, the coverage was there. But if your homeowners insurance premiums tripled every 3 years to the point that you were paying, roughly the cost of what your, principal and interest payment would be, at that point, maybe you're thinking, self-funding might be a better strategy here because I could just sock that money away. And that is effectively what happened in the industry, right? Clients started to see the news. I mean, I used to cover New England from a sales desk, and we had a carrier there that's well known that was in the traditional space, and I mean, it was in the Boston Globe, right? Frequently about rate increases, and not on the front page, but in the business section. And so, consumers were aware, but probably worse than that, producers were well aware because every year they get, their clients get this notice 30 days in advance of the premium due that, hey, your rates are going up. And they got really tired of having to have that conversation and felt burned by the industry. And so, obviously we had this flood of folks, turning to self-funding, but we also had the emergence of what we call hybrid or asset-based long-term care solutions, right? And the approach is to use a different contract type, right? Use life insurance or an annuity product as the chassis of the product, because that provides you a couple of things, right? First, it provides you some additional account values. Now we have a death benefit and cash value in addition to the premium and the LTC benefit. So we've eliminated that. So with that said, using those contract types provide those additional values, which negates that use it or lose it objection about traditional long-term care insurance. But additionally, those products, those contract types, I should say, are non-cancelable. So you as the consumer can certainly cancel it and get your money back if there's a return of premium or liquidity provision. But what it really means for you is that the issuer of the contract cannot make any changes to it once it's in force. So they cannot raise rates, they cannot lower benefits. You know exactly what you're going to pay and what your coverage is once it's issued, whether that's on a single premium or, a multi-pay basis, right? We do have payment options for these products, but the premiums are guaranteed and the death benefit is guaranteed and the LTC benefits are guaranteed, right? So it becomes a different value proposition.
Is there any correlation? And this shows I'm very much an annuity and business development expert. I'm not a long-term care expert, but we're in the golden age of annuities insofar as the 10-year treasury today is at 4.2, 4.3% versus 2020 when it was at 60 basis points, giving insurance companies an unprecedented amount of yield, which they can pass on to the consumers in the form of various guarantees. Does that apply to these strategies at all? Is there somewhat of a buying opportunity, or is there in fact a reverse trend simply because of the sheer number of people that need long-term care that's causing pressure on the industry overall?
Yeah, no, I mean it's the former, right? Pricing is as strong as it's been in many, many years. The risk, I think the carriers have a pretty good handle on the risk, right? They know the costs and the policies are inherently limited to some extent, which isn't to say that that's a downside for buying it, right? I mean, that's just that goes into the actuarial calculation on how we price the products. But yeah, I mean, we have seen carriers reprice multiple times since, 0% interest rate environment days, right? And those are the days where I was, wholesaling at a carrier. And even then, I will say pricing was compelling because it's all relative to what you can get on a fixed asset, right? But not to digress. I mean, to your point, yes, there's a buying opportunity. I will say it's not as time sensitive as an annuity. Typically, the reprice of a product requires state approval to some extent, even if it's like an informal filing. But we don't see the swings on pricing where, hey, we got premium bonus special, we got cap rates reduced or increased. We typically have some runway. We don't have any news of any pricing reductions. In fact, everything recently was all pricing enhancements within the last 6 to 12 months. So pricing is very strong. Products are compelling as they've ever been.
So three primary takeaways as I see it for hybrid versus traditional. The pricing or the guarantees and the pricing will not fundamentally change. It overcomes the if you don't use it, you lose it objection insofar as there's some type of death benefit or cash value. And then finally, you can do it in a multi-place structure, but there's a bit of to the same degree as in annuities, but a bit of a buying opportunity on the shelf right now.
100%. Yeah. And I mean, I think that what we'll see is, if anything, the preponderance of need is actually a good thing for consumers, right? Kind of counterintuitively, because, think about, call it the golden age of annuities. Well, part of that, Ben, is the 10-year. Part of that's the macroeconomic environment. But I tend to think that the other part of that, which is equally weighted, is the consumer opportunity. Right? These companies are clamoring for boomers' dollars. There's a tremendous amount of wealth concentrated in a group of people that are aging. Right? So we need to have solutions for them. And that competition is good for clients. Right? We have A+ rated companies, name brand, right? Strong companies that have a history of really strong products are coming out with innovations even on their existing product chassis to compete with one another for those boomers' dollars. There's a buying opportunity. There's no time limit on it though. I mean, we have a lot of runway, to take care of a lot of people.
We just did a crash course in hybrid long-term care for producers wanting to get into this space or wanting a partner in this space. We'll have all of Drew's contact information, but I know a lot of producers are saying right now, well, I do index universal life with chronic illness riders or some type of riders. Something is better than nothing. And I want to also address income doublers for health impairment on annuities as well. After I think I know you're going to agree that something is better than nothing. But if the client is insurable and they have the premium, are we effectively trying to cut down a tree with a Swiss Army knife when you simply rely on an index universal life policy with a chronic illness rider? And hopefully this doesn't cause a huge amount of controversy. That's not my intent.
There's this underlying premise of good faith, which I appreciate, right? I mean, so if you're at least engaging with the idea that long-term care planning is important and the risk needs to be addressed, right? Then using riders, that's fine when you're selling a life insurance policy, right? To the way I view this, and look, I have, I sell life insurance with LTC riders here in my role at SMS. So it's not that I think that there's anything inherently wrong with that strategy per se, but what is the primary goal you're looking to accomplish? If you're looking to accomplish death benefit protection plus, tax efficient cash accumulation for supplemental retirement income, great. That's a terrific way, reason to use IUL. And the challenge with that is if you're selling an IUL for income that has an LTC rider, what are you doing to the death benefit? What's happening to the policy over time? You need to be cognizant of that. And there are ways to design it that's effective. But generally speaking, those riders come in a couple of varieties, right? Though you've used the word chronic illness, that is not a long-term care rider, right? Because in order to qualify for that, you have to have one of the illnesses that is covered by the provision, by the endorsement in the contract. Well, Alzheimer's may not be a covered illness, right? Oftentimes, long-term care is not associated with an illness per se, but just with aging, right? Most of these do not cover arthritis as a chronic illness, right? But arthritis would, cause you to have difficulty holding a spoon or buttoning a shirt, which are two of the 6 activities of daily living, which would trigger a benefit for a true LTC product. So there are true LTC riders, right? A number of carriers, oftentimes it's the carriers that have the hybrid products, your Nationwides, your Lincolns, your John Hancocks, have true LTC riders that are, that function the same way as an LTC policy would. But essentially what you're doing is buying a death benefit, and then you have the ability to accelerate that death benefit over a period of time. And there's a small cost in the premium for it. Typically per premium dollar, a hybrid LTC policy like your Nationwide Care Matters, your One America Asset Care, your Lincoln Money Guard, per premium dollar, it's much more efficient because the death benefit is essentially your premium back plus a little bit of interest. And your bucket of LTC is much larger than the death benefit would be for the same premium dollar. And it's really easy way to understand this, right? The insurance company knows you're going to die. So everyone's going to die. We know the pricing of mortality really well. Not everyone's going to need long-term care, right? And so, they can price the benefit for long-term care more richly than they can for the death benefit, excluding attrition, because the risk isn't guaranteed. You're going to die. You're not necessarily going to need long.
From an annuity perspective, and I would be remiss if I didn't cover this in today's episode, and this isn't a question for you, Drew. It's my own, not observation, but strong feeling. I'll talk about health impairment doublers or nursing home confinement doublers on annuities with income riders really quickly, and we can do a whole episode or sales video on this. But just so everybody is aware, not all, but a majority of those doublers are contingent upon there still being cash value in the contract. Even with some of our best carriers, the likelihood, especially with income being on sale and individuals getting 7, 8, 9, 10% of their purchase premium paid to them in the form of guaranteed income at the age of 65 or 70, the likelihood that in their 80s, there's going to be that cash value that thus allows that health impairment or nursing home confinement doubler to be exercised is going to be slim to none. So in the interest of dispelling some of the myths where we think we're providing adequate coverage, while something is better than nothing, there might be something better, assuming your client fits the profile, can get through the underwriting, which I'd like to end there, or I'd like to one more takeaway that to quickly touch on. We're coming up on time here, and I really appreciate it, Drew. But uh, there's a lot of hybrid long-term care, specifically on the annuity products, where there's a pretty high likelihood that most consumers, even with some challenges, could get through underwriting.
Yeah, absolutely. And a good segue. And I'll say I completely agree with your take on the income doublers. There are a couple of carriers where you have an opportunity for there to be some cash value. But I think one of the important things here, and when you look at an illustration for a hybrid LTC product, whether it's an annuity based or a life insurance based product, a true LTC, qualified, pays out benefits tax free, you're going to have guarantees, right? We like guaranteed income because of the guarantees, right? These products are fully guaranteed, which is a fundamentally different asset, if you will, to hold within a portfolio, right? And it provides a different kind of anchor for a plan. But looking at the annuity, we've seen an emergence of annuity-based products, and I think let's just talk about underwriting as a whole, because this is really where the annuity products fit in. I think of long-term care insurance as an underwriting waterfall, right? Go down and go down. So starting at your folks who are in their 50s and 60s, typically standard health, right? You don't have to be the healthiest client in the world, but without major medical history, without current pain issues or physical therapy, pending procedures, that person who you feel like you could get approved for life insurance is likely to be approvable for the life-based hybrid products, which those are really the gold standard. They provide the most leverage. They're priced on age and gender. They're just yes or no decisions. It's simplified underwriting, so no needles or fluids, no paramed exam, no medical records even, right? It's a telephone interview, prescription database, an MIB check, and then you get a yes or no decision. So really quick, not certainly not the rigmarole of a permanent life insurance policy can be. But if we can't get approved for those, and typically we're looking at folks 65 plus, particularly in the 70s, where our cumulative underwriting debits, if you will, have started to add up, right? And maybe it's not one particular condition, but multiple conditions that would make you uninsurable for these hybrid products. We've got some really compelling annuity-based products that aren't priced on age, right? Because annuities aren't priced on age, right? We're priced on the macroeconomic conditions and the premium you put in and the structure of the product. Issuing up to age 80, issuing up to age 84 in some instances, issuing up to age 87 with the exception at the home office with some carriers. We have the ability to double or triple clients' money plus some interest in a way that I think is really compelling, particularly when you're much closer to that care need. And I'm personally quite bullish on these products right now and moving forward, because when we think about the demographics of this country, we're at peak 65, right? The top of the silver tsunami, which, we've still got plenty of folks aging into this, right? But we've got a lot of folks that didn't buy insurance on the back end of this that we would love to approach, but we feel like, hey, maybe we can't get them approved. Well, we've got annuity products that are kind of that second tier of that waterfall, not as rich of pricing, but still very attractive, where we can go target those clients within a book. And hey, just to throw a little sales idea out here, how many of those folks have non-qualified annuities with significant gains that have been deferred? 1035 opportunity comes over tax-free via 1035 exchange. Benefits remain tax-free because they're Pension Protection Act qualified products. Right? Something I would love to talk with anybody listening about, opportunity to mine the book. But, I think that we're going to have a lot of runway with those. See some new carriers potentially coming out with some products, but, we have some that we already like quite a bit. And then, we can fall down to that third waterfall, right? The bottom, hey, this person is uninsurable. Well, we still have some opportunity, believe it or not.
Indeed, we do.
North American Secure Horizon Plus. I mean, I know we're going to plug a bunch of product today, but won a bunch of awards, has been the hottest selling annuity in the business for good reason. right? Now, that is not a sufficient starting point for long-term care planning for somebody who's insurable if they, if the goal is long-term care, right? But it is a really attractive, worst case scenario, right? And then you could even look at doublers too with some of the carriers that are priced appropriately.
100% of something is better than 0% of nothing.
That is
All
true.
right, listeners, key takeaways from today is if you're totally comfortable having this conversation, you need to be having it a lot more because 95% of consumers want to have this conversation. Only 35% have been engaged on this conversation. We covered book insurance. We covered this is both a need for your clients, this is a need for your practice. And if you're not totally fluent or comfortable having this conversation, talk to Drew and I can get you in touch with Drew. And again, we can work in a point of sale capacity. So this very important, but unfortunately not totally utilized element of our insurance toolkit is leveraged. Drew, before you go, real quickly, for the time being, we're still ending IGO. That's in good order with a brief anecdote. If you've had a great or good customer service experience, this ending, folks, is subject to change on this podcast and YouTube adventure that I've started. But for the time being, I still really like to hear these things given the deleterious nature of service across industries over the last 5 years. Some would argue more. Drew?
Yeah, so went to test drive cars with my wife over the weekend. It was our anniversary, so we took our daughters up to grandma and grandpa's, and a very exciting weekend of hanging some curtains and test driving some vehicles. So those of you with young children can certainly relate to that. And the dealer, the Acura dealer, car sales was very good. I think that where he excelled is, and he asked me what I do for a living. I told him I was in sales, and he really pulled off the gas on me. So, it was a quality experience. And I agree with you. We have seen a deterioration of it. Luckily for us in our business, continuing to provide good service just now sets us apart even more.
So last week we talked to Nick Schmidt about seminar marketing and did a deep dive into Frank Maselli and the emotional dynamic. Disarm in order to engage. So there is a service element there of recognizing your audience, and from a salesperson to a salesperson saying, you know what? In this particular case, it's not even that I or you or probably this gentleman is particularly salesy, but if you already work in this industry or in a consumer facing or business to business capacity consultation, you know some of the strings to pull, in which case, if you already know those strings are going to be pulled, why don't you just give Drew a little bit of space? And sometimes is more. That's fantastic, Drew. Drew, thank you so much for being on episode 4 of IGO. That's in good order. Have a fantastic day. I'll see you at the end of the month.
My sincere pleasure, Ben. Thanks for having me, man.
You got it. All right, listeners, that was episode 4 of IGO. That's in good order. I'm Ben Braverman, Senior Consultant at SMS Financial Solutions. Tune in next week. We'll be talking to an individual who recently delivered a TED Talk and is an expert on podcasting. So he's probably going to totally dismantle everything that I've done over the last 4 episodes, which should only help to improve your listening experience going forward. Have a great day, everybody.